Welcome back to the channel. Over the past 7 days, global financial markets have experienced significant volatility as major central banks recalibrated their monetary policy stances in response to shifting macroeconomic data and geopolitical developments. Today, we are breaking down the structural shifts at the Federal Reserve, the Bank of England's ongoing battle with supply-side inflation, and a historic policy normalization milestone from the Bank of Japan. We begin in the United States, where the Federal Open Market Committee, under new chair Kevin Warsh, maintained the federal funds rate at a restrictive target range of 3.50% to 3.75%. However, the core narrative lies in the updated summary of economic projections. The FOMC removed its traditional forward guidance and revised its year-end inflation forecast upward to 3.8%. Crucially, the dot plot and policy statement indicate a hawkish pivot, shifting consensus expectations away from monetary easing toward a potential policy rate hike before the conclusion of 2026. For fixed income and mortgage markets, this solidifies a prolonged, higher-for-longer interest rate environment. In the United Kingdom, the Bank of England's Monetary Policy Committee mirrored this cautious approach, voting 7-2 to hold its base rate at 3.75%. The minority vote consisted of 2 hawkish members advocating for a 25 basis point hike to 4.0%. Governor Andrew Bailey noted that while front-month crude oil contracts have retraced, the domestic economy continues to process secondary inflationary pressures from prolonged energy shocks. This supply-side pressure is evident across the Eurozone as well. Germany's latest data revealed producer price inflation hitting 3.8% annualized, underscoring persistent input cost pressures within European manufacturing. Geopolitical developments provided a counterweight to these hawkish central bank signals. Reports that President Trump and Iran have entered into a formal framework agreement to conclude the regional conflict immediately altered energy market fundamentals. As geopolitical risk premiums compressed, crude oil prices experienced a sharp downside correction. If this de-escalation holds, the subsequent expansion of global energy supply could significantly mitigate global producer price pressures, offering central banks a viable path toward inflation convergence without necessitating deeper demand destruction. Finally, we turn to Asia for the week's most structural shift. The Bank of Japan aggressively accelerated its departure from decades of ultra-loose monetary policy, raising its short-term policy rate to 1.0%. This marks the highest benchmark rate for Japan since 1995. This aggressive normalization effectively curtails the long-standing global yen carry trade, forcing institutional investors to rebalance liquidity and capital allocations across international sovereign bond and foreign exchange markets. From monetary tightening in Tokyo to hawkish structural shifts in Washington, the global macroeconomic landscape is undergoing a profound transition. While persistent core inflation keeps central banks restrictive, the deflationary impulse from cooling energy markets remains the key variable to watch. How do you view the Bank of Japan's rate hike impacting global liquidity? Let us know your macro thesis in the comments below. Capitalize on the subscribe button for quantitative market analysis, and we will see you in the next breakdown.